WCM Investment Management, a global high-conviction investor focused on quality growth. Now, corporate culture is also highly rated when it comes to factors that WCM considers when investing, but portfolio manager Ryan Quinn says there is no such thing as good or bad corporate culture. Ryan joined us a short time ago to discuss their style of investing, but first, Nadine asked about WCM's relationship with Future Generation, which is celebrating its 10th anniversary of investing for impact.
We were introduced to Future Gen by some of our partners here in Australia, and we really found that their cause resonates with our core principles. At WCM, our core principles are fun, gratitude, and serve others. Despite being in the money management industry, we view it as a way to really make a big impact on the world, not just our employees, but also the groups that we serve.
Okay, so maybe then we can learn a little bit more about WCM. So it's a big question, but what is your sort of investment strategy, investment philosophy?
Sure. So we've been growth investors, broadly speaking. We have a global portfolio that invests in the best 35 to 40 stocks we can find across the world. We are growth investors basically just by believing in the fact that things like technology and healthcare are going to be the fastest and most impactful things going on in the world for the foreseeable future. And so we then will apply some typical screens that kind of anyone can do to narrow the growth world down. That usually leads to a lot of ideas coming from technology and healthcare or some industrials businesses. It usually leads us to stray away from things like utilities and real estate, some materials to some degree. So holding ourselves accountable to really a very high conviction portfolio in the areas of the world we think have the best opportunity to growth is kind of the best way to describe what WCM does.
Okay, so that's interesting because you're talking about the best places in the world as opposed to necessarily thematics. So it's not that you look for the AI thematic, or it's not that, big mega cap tech. It's not that you're limiting that high conviction world?
No, I think when we find individual companies that are extremely attractive from a growth perspective, they are usually touching some theme in the world, whether that's AI or just the general consumption of technology, right? The cell phones we use, the computers that are driving everything, and then when it relates to healthcare, there's pharmaceutical businesses that are extremely important. There are life science tools businesses that are selling into hospitals and labs that again have very strong and durable growth characteristics. But then, as I mentioned, in industrials, we can have exposure to railroad businesses or trash companies or flooring companies that are selling into both home and commercial areas. So while 35 to 40 stocks probably sounds concentrated and probably sounds fairly limited, the actual number of thematics that we can get exposure to through individual company selection is quite broad.
Okay, interesting. So how do you separate quality from quality growth from just growth?
Sure. So quality, goes kind of back to some things that anyone can do, right? So we screen out businesses that rely heavily on debt. We screen for businesses that have high and rising return on invested capital, a history of margin expansion, those types of things. Taking it one level further, we love businesses that have pricing power, that have sticky customer relationships, high switching costs, those types of things. Those are kind of very typical quality screens. But then from the next step perspective and what makes WCM different is the way we focus on the growth of a company's competitive advantage. We're not willing to buy a business just because it has good standing in a marketplace, or it's got said another way, an economic moat. We really want to own businesses that are growing their competitive advantage versus their peers in a durable nature.
And so that must mean you've got a lot of engagement happening with management of a business, is that correct?
It's certainly part of our fundamental process. Understanding who's at the helm is very important. CEOs turn over a bit more frequently these days than they did in the past. And so understanding what the mission is of the business, and that's where our corporate culture work comes in as well.
Okay, so how do you define corporate culture? Because is this just the S in ESG, or how do you determine what that corporate culture is?
Sure. So the interesting question about corporate culture is there is no good or bad corporate culture. right? We invest in a wide range of businesses across a number of different industries. And so the corporate culture that's best for any given business, what we've come up to is that it's aligned with the company's competitive advantage. A company's culture is going to define employee behavior. Employee behavior will lead to business outcomes. So that alignment is key. Secondly, it has to be strong and broadly understood across the company, from the front door all the way up to the top floor, so that everyone knows in what direction they're supposed to be performing, whether you're at the railroad or a technology company, healthcare, however you want to look at it. And lastly is adaptability. We've seen a lot of businesses that had a wide moat all of a sudden, not all of a sudden, usually over time, get competed away or eroded away because they're not adapting to internal or external threats to the market. So adaptability over time is going to be key as well.
Okay, so if you have this 35, say, high conviction list, what time frame are you looking to invest in these companies for?
I think that's, in addition to viewing concentration as an advantage in terms of having conviction in what we're investing in, making sure that we really hold ourselves accountable for the best 35 investments we can find, our time horizon is also an advantage. It's very hard to have an information edge over the next 6 or 12 months, but if you can have an information edge or a differentiating view over year 2, 3, 4, beyond, then that can be a business that can grow at a fantastic rate for you and really generate strong compounding returns. So for that reason, we do take a 5+ year time horizon on any investment that we are considering, and that differentiates us from the market and allows us to have a differentiated view. Okay,
and just final question. Is there any part of the world that is proving more fertile right now for opportunities?
Yes, I would say that, certainly in Silicon Valley, what's happening with artificial intelligence is fantastic. Within the healthcare space, innovations around diabetes and weight loss are happening from the U.S. and as well as in Denmark. Then there are larger trends that a wide range of businesses are getting exposure to, whether it's deglobalization and onshoring, the electrical grid, the pivot from coal or towards more greener energy is going to be a step function, and there's going to be times when electricity is going to be more important, but then wind and solar will have a play. We're also excited about aerospace and defense businesses all having very strong growth trajectories. So those themes are probably the most exciting thing. There are different companies across the world that will benefit from them.